Good afternoon and welcome this afternoon to Calendars, Condors, and Butterflies. Oh my, it is going to be an interesting webcast today since we are just ahead of earnings season. That brings about a little bit of volatility. Plus, it's Friday, so that brings about a bit of pre-weekend volatility as well. I'm joined out there in the chat by my good friend Cameron May. He's 20-plus year veteran, 30-plus year veteran of the financial markets. We're getting on in years these days. But Cameron is there to help facilitate the conversation. So please ask him questions along the way. Keep him busy. He's put already in there the link to our social media, to some of our social media. You can find Cameron and myself on LinkedIn. He's got the LinkedIn links right there. You can also find us on X at Ben Watson CS, at Cameron May CS. Join us over there. We have a great conversation going on over there. It's a good way to keep in touch with us and with what is going on in the market. So as we get started this afternoon, we appreciate you being here, whether you are here for the first time or for the, 100th time. In this particular webcast, it's relatively new. So some of you have just found this webcast. We're glad to have you with us. And if you are in the recorded version of this webcast, thank you for being there as well. Leave us a comment in the comments section so that we know that you are out there. So I talked just a little bit about this. We're ahead of earnings season. That brings about a bit of volatility. The VIX has been elevated in the last few days, although it has come back in just a little bit. And as we get into some of these discussions, we've got a number of earnings announcements that are coming up that may bring a bit of change to that implied volatility scenario. So we'll talk about those as we get in here. A couple of quick housekeeping items, though, as we get started. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice about any particular security or account type or strategy. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction. Now, when we're talking about American-style options, whenever a trader is short an American-style option, there's the potential that that option could be assigned early. The Paper Money platform, the Thinkorswim desktop software platform, the Paper Money version that we will be using is a great learning environment. It is not, however, a guarantee of future success. It doesn't do things like facilitating that early assignment of short options. So be aware of that. So I wanted to bring those two up in the same discussion so that you know that if you're practicing in Paper Money and you move to live trading and you've never been assigned on a short option, it can and potentially does happen in a live trading account. So just be aware of that. We'll talk about some of those characteristics as we get into closer into these discussions. Also, short-term trading and including trades that begin and end in the same day at the end of the lifespan of an option, sometimes referred to as 0 DTE options. Those carry with them some specific risks. Make sure that you're aware of those risks. Make sure that you're aware of things like liquidity and other considerations with that particular strategy. So just simply keep that in mind if you are a short-term trader. Remember that there is risk out there in the market, regardless of the instrument, regardless of what method of analysis you use, regardless of what has happened before. Past performance, no guarantee of future results. So let's jump out here and take a look. I've got an example that I wanted to put on here since the name of this particular webcast is Calendars, Condors, and Butterflies. And I always in my head add the oh my to that. But I wanted to take a look at the first trade here in this first illustrative and educational example as I think kind of an out-of-the-box approach to a trade that is a trade idea that is sometimes misunderstood, but is also pretty straightforward when you break it down. And that is a calendar spread. And a calendar spread is a little bit different than a vertical spread in that a calendar spread splits simply the expiration dates, not the strike prices. A vertical spread, same expiration, different strikes. Calendar spread, same strikes, different expirations. And it changes the nature of the trade. It changes our expectations. It changes the cost and potential loss structure on the trade. So let's put one of these together and let me walk you through my thought process in this particular illustrative example to help us to understand a calendar spread. So this is Pepsi or PepsiCo, more formally. And Pepsi has kind of been trending sideways, and it's generally been gravitating, if you notice over the course of perhaps the last 6 or 8 months or so, kind of been gravitating back towards this 140 level. In fact, it's broken below that 140 level a couple of times here. Generally, it seems, though, that 140 level around that area has become a pretty consistent level of support. Now, that is not a guarantee that it will do so again. But if there's an opportunity for this to kind of change its direction, it may very well be based on what's coming up on the 3rd of February, which is the earnings announcement, their next earnings announcement out there in the list. Now, that is not necessarily set in stone. That date could change, but we're going to go with that. And the option market is going with that as well. The two other indicators that I've got here on the chart besides the price, implied volatility and an RSI, relative strength index. Now, Cameron May does a great job in explaining lots of different technical indicators. In fact, I know he's got a couple of different webcasts where he talks about and breaks down how to use the RSI. So I'm going to let Cameron post a link to that out there in the chat so that you've got some additional resources. And we won't spend a lot of time talking about what the RSI is, how it's constructed and how it works, all of those things. But the RSI here generally falling off a little bit. We see that we've got some downward momentum. We've, in fact, perhaps had a couple of series of bear flag types of trades, not hugely bearish here, but there does seem to be a little bit of a gravitational pull down to that support level, down around that 141 level. Does not by any means guarantee that it's going to go there. And it doesn't mean that on this earnings announcement that whatever news is going to come out is going to drag the price down to that level. But that is certainly a possibility, the price moving down to that previous level of support that's been tested multiple times. Now, going into the earnings announcement, you'll notice what happens to implied volatility on this particular stock. And this is, I think, more a typical type of pattern than some that we see in the technology space. But you generally see that implied volatility, or in other words, supply and demand for options, tends to rise. That volatility as an expression of supply and demand for options is tending to rise into the earnings announcement. And then once the news is known, the implied volatility tends to fall or collapse or get crushed. So that's a typical pattern. Doesn't mean that it'll happen this next time. It just means that it's happened once, twice, 3, 4 times in this recent time frame. So that's kind of a general expectation here that there is some anticipation going into the earnings announcement. Here's the earnings announcement over the horizon, and lo and behold, implied volatility is rising. That suggests that there are really kind of two things going on. One, there is some speculative pressure because there are some investors who are thinking, hey, Pepsi's going to go down, so I'm going to buy puts, and I'm going to speculate on that. Hey, Pepsi's going to go up, so I'm going to buy calls, and I'm going to speculate on that. So I'm going to make those calls more expensive. And then there are also very likely some longer-term holders of Pepsi stock that are saying, you know what? Going into this earnings announcement with a lot of geopolitical risk and a lot of volatility risk out there in the market, and we're going into January, and boy, Ozempic and all of these other things have people not drinking sugared sodas as much, unless you live here in Utah and you go to one of the dirty soda shops. There's a possibility that their earnings could be worse than expected. And so I'm going to protect my long stock positions, and I'm going to buy put options. And so those puts become more expensive. So for all of those different reasons, not necessarily the dirty soda shops, but for all of those reasons, implied volatility seems to be rising. And then once the news is known, once they come out with their earnings announcement, implied volatility falls. So that means that right now there's some elevated implied volatility. It also means that on the backside of the earnings announcement over here, date-wise, that implied volatility is likely to be lower. So what if we put together a trade that might be able to take advantage of that elevated implied volatility now and lower implied volatility out in the future? So that's where a calendar spread comes into play. A calendar spread oftentimes is traded as somewhat of a neutral strategy, meaning not a lot of directional movement, but it can be structured as a directional trade or a little bit more directionality to it. So we'll put together a couple of different ideas here. So what I'm going to do, I'm going to kill those annotations really quickly. We'll come back over here. We'll go to the trade tab. So my premise is really this. My premise is that price is maybe going to move down to that 141 level, down to that level of support, that gravitational pull, somewhere at or before or maybe even after the earnings announcement. So I'm going to go to the trade tab here for Pepsi. And we're going to take a look at this trade tab. So what I'm going to look at, first of all, is I'm going to come down here to today's option statistics. Now, somebody had asked me the question about this the other day in my Trading Index Options webcast. And so I wanted to kind of explain this relationship here, because you look at this current implied volatility percentile, and it says the 29th percentile. You look at this implied volatility percent, and it says 26. Well, which one is right? Well, that implied volatility percent is the average implied volatility across all of the strikes and expirations for this stock right now. But where that is relative to its highs and lows, where it is in this relative range between its 52-week high and its 52-week low, gives us a percentile ranking. That percentile ranking is roughly the 29th percentile. Now, mathematical purists are going to argue with me on this. I'm not worried about the specifics of this, because all it's doing, it's telling us a relative range. So is 26% implied volatility high or low? Well, it's in the lower third of implied volatility, where implied volatility has been in the last year. And it's likely rising. We can see that on the chart. So that may benefit a long option, especially if the price of the stock goes down. But if we're short an option, that's going to hurt us, a rise in implied volatility, unless there's some event that might drop that implied volatility in the near term, like an earnings announcement. So what we're going to do is we're going to put together a calendar spread here, like we've been talking about. And I'm going to come over here to the right-hand side. And then on the right-hand side of this option chain, this area over here, what I'm seeing are current levels of implied volatility for each one of these expirations. All of those get averaged to get to our average implied volatility down here, right? But each one of those individual implied volatilities is relative to its own expiration. So I notice that I have an elevated, so I've got 36% implied volatility on the option that expires today. And we're near the end of the day, so I'm not going to worry about those at this point. Then I've got a little bit of a drop off of implied volatility. It goes down to 21%. Then it goes back up again to 30%. And then it starts going down again. So I know even without looking at the chart and the calendar, that it's very likely there is an earnings announcement. I'm just going to put an E right there for earnings, that there's an earnings announcement right there sometime in that particular week. Okay. I love this conversation. I love the chats that are going on. So that's great. So what that also tells me is that in that expiration week, the expected move between now and that expiration is about $6.79, $6.80. Absolute value, which means up or down. So where is the price of the stock right now? It's about 144. A move down to 141 is not outside that realm of possible moves or expected moves. So what we can do is we can use that as our first leg of this calendar spread, based on what we expect price to do and based on what our expectation is in implied volatility and duration, where that earnings announcement is. So I want to sell that relatively elevated implied volatility and I want to buy an option that has relatively low implied volatility. So here's what I'm going to do. I'm going to go to this 6 February expiration, 14 days to go from now. We know from looking at the chart and from seeing the implied volatility that our earnings announcement falls within this week. That's great. That actually works fine because I want to be out of this trade either right at or immediately after the earnings announcement, when the crush has happened, theoretically. So I'm going to come down here and I'm going to go to the put strikes over on the right-hand side, and I'm going to go right down here to about the 141 strike. Remember where that level of support was? That's where I expect the price of the stock to go, is down to 141. So because that implied volatility is a little bit higher than the average, a little bit higher than the surrounding expirations, I'm going to sell that higher implied volatility. So I'm going to sell the 141 put. So I'm just going to click on that and sell, create an order to sell the 141 put in the 6 February expiration. Now I'm going to close that down. And I'm going to say, all right, where could I buy an option that has lower implied volatility? That if implied volatility does rise, that's going to benefit from that rise in implied volatility. So I might go out here, say for instance, to the 20 February. So I've got about a 4% disparity or dispersal between those two levels of implied volatility. I might even go a little bit further, but this is a balancing act, because the further out that I go to buy the long leg of this trade, the more I'm going to pay for it. So this becomes a more expensive trade. But the less sensitive it is to time decay, but the more sensitive it is to changes in implied volatility. Oh, I've always got a trade-off. There is always a trade-off when you're talking about option Greeks. There is never an absolute best or an absolute, this is the one that you have to choose. It is always a trade-off. It is always dynamic. So keep that in mind. So here's what I'm going to do. I'm going to go out to the 28 day to go until expiration, the 20 February expiration, and I'm going to open that one up. And I'm going to go to that same strike, the 141 strike. And since I've created the order to sell that 141 strike in the shorter duration expiration, I'm going to create an order to buy the 141 strike in the longer dated expiration. So I'm buying a put and selling a put at the same time, but they're two different expiration dates. And so what I get is this calendar spread. So I've got about, 3 weeks difference, 2 weeks difference between these expiration dates. And I've got the same strike price, but they're different prices and different sensitivities. So what I'm ending up with when I buy one and sell one, now this is not buying one and selling one to close it, or selling one and buying one to close it. These are two expiration dates, two separate instruments. Buying one that expires in the 20th of February expiration, selling one that expires the 6th of February expiration, I come up with a net debit for this trade of 50 cents. Here's the cool thing about a calendar spread. Generally, it's a relatively inexpensive. Now, I say that with big emphasis on the word relatively, because you get into a higher price stock and calendar spreads can still be a little bit more expensive. But this is a relatively inexpensive cost to enter trade that gives me some downside exposure. So 50 cent net debit, click on confirm and send. My total exposure in this trade, theoretical maximum loss. Now, theoretical maximum loss, or cost of the trade in this particular case, is $50. 50 cents times 100 shares, $50. Low cost to enter the trade. But let's do this before we fire that order off. Let's pop over here and let's right click and let's send this over to the Analyze tab and take a look at this trade. So here's our trade. Let me kind of pop this Analyze tab up. And by the way, you'll see these risk profile graphs on the Schwab Network. Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions. It's us coaches that produce all of those risk profiles in the background that you see on the Schwab Network. But you've also got some great webcasts that talk about using the Analyze tab. In fact, I'm going to let Cameron shamelessly plug his webcast that he did a little while ago on using the Analyze tab and how you come up with these risk profile graphs. But here's the risk profile graph for this calendar spread. I'm going to spread this out a little bit so that you can kind of see what this really looks like and what this is doing. This calendar spread, again, remember what this calendar spread is doing is it's buying a put and it's selling a put, 2 different expiration dates. It creates this characteristic profile of a calendar spread. So what I'm going to do is I'm going to say, all right, I know that my expiration is out here on the 20th of February. I'm going to advance this number out here. That puts this wider, kind of lighter shaded area. That's the 1 standard deviation range of where price is likely to be. Not a guarantee by any means, but that's where it's probably going to be within that range. You notice that all of this calendar spread falls within that range, that probable range. Now, the other thing to think about here is I can pop in and I can put in slices, those lines on the chart at roughly my break-even points, the points at which that risk profile graph crosses the 0 line. So that's the point at which I could theoretically, at expiration, make some money on the trade, or at least break even. So that puts this lower break even down to 134. So the stock could move quite a bit lower. Puts that break even on the upside up to 148. The stock could move higher. Where this trade gets to theoretical maximum gain is if at expiration it is right at 141. The likelihood of it being right at 141, pinning at that strike, is not very good. Not very high probability. So this is a lower probability trade if you're trying to get to theoretical maximum gain. But if it's an area where you're trying to get to some gain in the trade, then this becomes much more like kind of an iron condor, but a cheaper debit version of an iron condor, in that if you were to take that trade off at some theoretical maximum gain, you're increasing the probability of success in this trade significantly because you're taking that trade off at a point where it doesn't have to hit this discrete target right there at the peak of that graph, which is fine. And if implied volatility goes down after the earnings announcement, that's going to work a lot harder on this short strike than it is on my long strike. So it's going to eat away at the short strike, which is great because I want that one to get as cheap as possible, as quick as possible. I want my long leg to stay fairly elevated in price. Basically, I want that spread to widen out. I'm buying it for 50 cents. I want to be able to sell this for maybe $1. So if I can sell this for essentially $1, like right here, I got a pretty big range of price movement in the price of the stock, down all the way to 137, up all the way roughly to about 145. Oh, that falls kind of within that range of potential movement, doesn't it? So that's okay. I'm fine with that. And that actually gives me a higher probability trade in this particular perspective. So I'm going to put this trade on, but I'm going to show you what we're going to do with this calendar spread here really quickly as we come back to this trade. Let me kill those annotations and let me pop back into the trade itself off of the Analyze tab. And I'm going to say, hey, you know what? This is cool, but what if we did this? What if we changed this to a first triggers sequential order? And I said, cool, I want to pay 50 cents for this. I want to take this trade off if I can double that. That's pretty, that's pretty good. If I can double that 50 cents. So if I can sell this trade back for $1, low cost to entry, gives me exposure to the downside move, and it takes advantage of the upcoming earnings announcement, cool. So if I right click on this and I create an opposite order, now I've got an order to sell that calendar spread. I'm going to make that a limit order. I want to sell that calendar spread for, we'll be aggressive here, $1 or better. Now, Greg asks a question, is this a neutral trade? Sorta. It's kind of a neutral trade. It doesn't need necessarily a lot of directional movement, but the way that we've structured this with that potential move down to that 141, because remember, the price of the stock's currently sitting at about Pepsi's currently, I think, what did we say? Back over here to the chart. Pepsi's currently at about 144. So it does take into account, gives you some exposure to that possible move down to the downside just a little bit. It's not hugely directional to the downside. It's not hugely directional to the upside. So it's neither significantly bullish nor significantly bearish. It's fairly neutral. So I'm going to look at taking this trade off at about $1. If I can take it off for $1, if I can sell this trade for $1, cool. I'll do that all the time. May not be able to. So you got to manage it. It's not a trade that you can just set and forget. So I'm going to put that out there. I'm going to make that good till canceled, and I'm going to click on confirm and send. We're going to read through this order. I'm going to send this to my market movers group just so I can keep track of it. But I've created an order to buy the calendar spread for 50 cents limit, and in order to sell the calendar spread for $1 limit, which says or better, $1 or better. So if I can sell it for $1.10, cool, even better. And I'm going to go ahead and I'm going to fire that order off. Total cost of the trade, $50. Click on send. We're going to fire that order off, and we'll see if that'll fill. Now, here's the thing. Boom, 50 cents. We got it. Here's the thing. We're talking about 2 legs to this trade. So that's only 2 bid-ask spreads that I have to deal with. So Koala asks a question, does it make sense to do calendar spreads on boring stocks like Procter & Gamble instead of ones that have the potential for a lot of movement like AMD? There's always a trade-off. And I think that's a phenomenal question to ask. Pop over here to the chart. Let's take a look. PG, Procter & Gamble. Doesn't move a lot. Implied volatility relatively low. In fact, implied volatility is down here about the 18th percentile, or excuse me, about 18%, probably in the maybe the 10th percentile or so. Let's just double check that real quick. Let's look at our trade tab. Let's open up our option statistics. Oh, I was close. 12th percentile, 29%, or excuse me, 18% implied volatility. So not very volatile stock. Doesn't move a lot, except around earnings. Well, we've just had earnings now. Implied volatility has crushed. It's pretty low. We go to the trade tab, and we were to try to create a trade like this. You see that we don't have a lot of disparity between these implied volatilities. In fact, even knowing that there's another earnings announcement further out in time, there's not a lot of disparity in those implied volatilities. So to try to capitalize on that, it doesn't give us much opportunity. In fact, it doesn't give us a lot of premium to do that. So we might say, well, if the price of the stock were to stay roughly the same, we could sell the at the money, which is the 150 strike, and we could buy the at the money, which is the 150 strike out here. And there's just not a lot of premium there to offset the cost of the long leg. So that's the challenge in a quote unquote boring stock, your term, boring stock, is that you don't have enough volatility necessarily to offset the cost of the put, the long leg. So it becomes a little bit more expensive trade with a lower probability of success. But if we were to do something similar, let's go to the charts and your other example here. And again, remember, these are just illustrative and educational examples. We were to look at something like AMD, where implied volatility right now is about 60%. You've got an earnings announcement over the horizon just a little bit. It's been on the rise to the upside. Let's go to the trade tab here on AMD, and let's scroll down to today's option statistics. Current level of implied volatility is 60%, and it's in the 36th percentile. So implied volatility is still rising. You've got some juicy premium there, relatively juicy. And you notice that here's our earnings announcement. I'm going to tell you that our earnings announcement is probably in this week here, the 6th February week, without even looking at the chart, because I can see that that's where that implied volatility is elevated. Let's go to the chart to confirm that. And in fact, the earnings announcement is on the 3rd. Guess what? It's in that week of expiration. The market, the option market knows. It always knows. So that implied volatility, that elevated implied volatility is coming in right here. So if we were to say, hey, I don't think this is going to move very much, I can sell let's sell, say, for instance, the 255. And we come back and we go out to the same spread here. Let's go out to the 20th of February. And we were to sell the 250 or buy the 255. It's a higher price stock, so you're dealing with more here, but on a percentage basis, you're getting more premium to make this a little bit cheaper. So that's the difference, Koala. It's always a trade-off. You always have to look at those possibilities. The thing about it is, this particular trade, because this is a more volatile stock, if we throw this over here on the Analyze tab and we take a look at it, There's our calendar spread. And we've got a relatively narrow range in which the price of the stock can move before we start getting into those loss areas. So that's one of the challenges in that type of trade, is that type of scenario. But it's certainly something that we can do ahead of an earnings announcement. So what I want to do this, I want to pop in here really quickly. I want to take a look at an earnings announcement that's just over the horizon here. Let's take a look at this one. This is Google. And Google's earnings announcement, again, is the 4th of February. Implied volatility is at 38% level. We go to the trade tab, and implied volatility, if we close down those expirations, implied volatility 38%. It's at the 33rd percentile. So implied volatility is in the bottom third and potentially rising as it goes into the earnings announcement. Let's see if we can create a calendar spread here. So if we look at the chart and we say, all right, fine, maybe there's this level of support down here at around the 310 mark. Now, the price of the stock doesn't have to move down. You can also create a calendar spread with call options and shade it to the call side or the more bullish side. That's fine. But what typically tends to happen to implied volatility when prices go up, implied volatility tends to come down. So using a call or a call calendar, you're kind of missing out on that little kicker of implied volatility juicing up those put options. Put options in general, but put options generally tend to get more expensive when the price of the stock goes down because institutions use those put options to hedge against long stock positions. So I'm going to look for this price to move down to the 310 level, thereabouts, some directional movement, not a huge amount of directional movement. So I'm going to go to the trade tab, and I'll answer Wiley's question. What would be a good scan to look for calendar spreads? If you're thinking about using a calendar spread ahead of an earnings announcement, a liquid stock that has liquid options, that has weekly expirations, so you've got more granularity, and one that has relatively low and rising implied volatility, which kind of puts you in that range of earnings announcements. So earnings announcements coming up within the next couple of weeks, because essentially what you're looking for is a disparity between implied volatilities, levels of implied volatility. So on this one, I'm going to look out at the 6th February expiration, 45% implied volatility, and I'm going to go out to the, we'll keep it just fairly small. We'll keep it to the 20 February expiration still. I'm going to go 6 February, and I'm going to sell the 310, and I'm going to go to the 20 Feb, and I'm going to buy the 310. And I'm going to do that for $1.75, right? Now, RBT says, why not use a call calendar? You could use a call calendar, absolutely. But when implied volatility goes down, if the price of the stock goes up, implied volatility is going to go down, and that's going to work against your long leg. So you can do both. There are strategies that do both, but same type of thing, right? There's not really a huge advantage to using a put calendar versus a call calendar. It depends on your directional opinion. My directional opinion in that particular case was the price was going to stay about the same. So you might get that additional bump or kicker from the implied volatility on the put option, working a little bit faster perhaps than on the call option. So here's what we've done is we've created this put calendar spread on Google. We're going to right click. We're going to send that to the Analyze tab. And you can see what that looks like in terms of that risk profile graph. Fairly wide range. If we set those to break even, set slices to break even, whoops, right there, set slices to break even, down to 288, up to 335. It can go up a little bit, it can go down a little bit, and we can get some gain in the trade. The likelihood of this hitting at 310 on expiration is fairly low. Low probability of getting the max theoretical gain. So disabuse yourself of the notion that a calendar spread is going to get you to max theoretical gain every time. It's not. It's just not. So think about this as a lower cost way to enter into a higher probability of not getting max theoretical gain, but getting some gain in the trade is the way that you might think about how this works. So that's a calendar spread. And again, you're dealing with two legs to this trade. But what if I still had kind of a bullish expectation? I could create this with calls. What if I go back to this chart and I say, hey, you know what? I've got rising implied volatility, and if implied volatility rises, but I've got that earnings announcement that might impact that short leg, what else could I do here to take advantage of this? Right? What else could I do to take advantage of this? Well, we might create a strategy here that would allow us kind of a similar scenario to take advantage of that upward movement. But you could do a vertical spread, but a vertical spread doesn't give you duration, doesn't let you split those expirations. So let's look at a trade that maybe gives us a little bit of duration here, takes it out a little bit further in time. So what I'm going to do is I'm going to put on something similar. I'm going to put on a butterfly spread in this particular case. Now, a butterfly spread is going to be 4 legs. It's going to be 4 legs to this trade. So slippage wise, it may have a little bit more impact in terms of slippage, might be a little bit harder to put on. But here's what I'm going to do. I'm going to go out, I'm going to go to the trade tab here, and I'm going to go to this 20 February expiration. So what I'm going to do in creating this trade is, let's see if we can, I started to put this trade on earlier. So let me see if I can copy this and put this in here. Copy. And I'm going to bring up my trade tab here just so that we can see what this looks like. There it is right there. Okay, so we're going to create a butterfly spread. But this is going to be a little bit different butterfly spread. This is going to be an unbalanced butterfly spread. A butterfly spread looks very much like that calendar spread in terms of risk profile graph. That would be at the same strike and with same width. But here's what I'm going to do. I'm going to kind of shift this and make this a little bit unbalanced. So we're going to go out to the 20 February expiration. We're going to use calls on this side. This might address that call side of the equation. I'm going to buy one of the 20 Feb call, 20 Feb 330 call, and sell one of the 20 Feb 350 call. So that's essentially going to be creating a long call vertical spread. So I'm going to essentially be buying this one and selling this one. Okay, 320 to 330, that's a $10 wide vertical spread. And then, or I'm sorry, out to 350. So that's going to be a little bit farther. So that's going to be 21. Now what I'm going to do is I'm going to sell another one of those 350s, and I'm going to buy a further out 355 call. Now, narrower width between the spread, a $20 wide here on the bottom side of this calendar spread, or excuse me, butterfly spread, and $5 wide on the top side. So let me show you how we're going to create this. I'll just do this step by step so that we can plug this in. So what I'm going to do is I'm going to go to the did we go to 320 or 330? We went 330, didn't we? 330. Okay, let's go to the 330. That's the at the money strike. So I'm going to buy one of those, and I'm going to sell one of the 350s. Okay, that's my vertical spread. Then I'm going to come back and I'm going to sell another one of the 350s, and I'm going to buy a 355. So essentially, I'm creating a short call vertical above my long call vertical. I'm using the proceeds of that short call vertical to offset the cost of that long call vertical. Let me take these down to 1. So it's 1, 2, and 1. This is a typical butterfly spread. You can see the cost for this trade, more expensive than the calendar spread, more slippage, but wait till you see the risk profile graph here. We're going to click on confirm and send, and you'll see what it means. My max profit is greater. In fact, I have the opportunity in this particular case to just about double with some directional movement. So this maybe has a little more directionality to it, less neutrality, but gives me the opportunity to perhaps double what I'm paying for the trade. Max loss in the trade, 660. But you got 4 legs. It might be harder to put this trade on from a slippage standpoint. So you might have to work this a little bit harder. But if we right click and we put this on the Analyze tab, so let me do this. Let me uncheck that calendar spread. Okay, here's our calendar spread, right? Roughly that same expectation, but a little bit of a downside move, okay? Now, if I uncheck the calendar spread and I check the butterfly spread that we just created, you see what the expectation is here. The expectation is upside movement. Now, theoretically, we would get to max theoretical gain if at expiration on the 20th, this is right at that 350 strike, but that's not very likely. Again, same limitation as a calendar spread. It's probably not going to hit that discrete point in time and space. But if this just keeps going up, let's say the earnings numbers blow things out and the price starts to go up, well, what I've done is I've locked in a potential upside gain here, potential maximum upside gain. At the same time, I've defined my downside risk in the trade. Two different flavors of the same kind of trade, the same thing. One is a little bit more directional, but it costs more to gain that directionality in this butterfly spread. The difference between these two trades, 660 versus a $1.75 or a $1.50 or whatever it was that we were paying for it to begin with, right? And in this case, that additional cost, still that's net debit, that buys that opportunity to lock in that potential upside gain. So all a butterfly spread is here, in this case, is in this specific case, is a short call vertical spread on top of a long call vertical spread, using the proceeds of the short call vertical that we're bringing in to help offset some of the cost, and by the way, reduce some of the extrinsic value risk of the long call vertical spread. So you just have four legs to pay attention to. How do you close either one of these down? Well, you're buying them to begin with. So the way that you close either one of these two trades down is you just buy back the spread as a whole, or scratch that, reverse it. You bought them to begin with. The way that you close them down is to sell them to close the trade down at the end of when it's either made what you've expected it to make, it's made some gain on the trade, or it's starting to lose and starting to go against you. Close the trade down by selling it for what you can sell it for. These types of short-term trades, relative short-term trades, which is where calendars and butterflies tend to fall, don't gain a lot from trying to either manage or adjust or fix. This is simply a trade put on if that expectation, especially around an earnings announcement, if the stock does what you think it's going to do, then look to manage that trade by taking it off when it's gained something of benefit to you. Take it off if it starts to go against you. If it doesn't do initially what you expected it to do, it doesn't necessarily benefit to leave this type of trade on, either a calendar or a butterfly, because you don't have, in this case, a lot of duration like you might have on a diagonal spread or a long call or a covered call or something like that. So fairly short iteration of the duration on these trades, but we've looked at a couple of different examples of how you might put butterflies and calendars together. So if you want to learn more about this, first of all, if you want to learn more about the coaches, come on over here to the schwab.com/coaching landing page. There's this great video right there. And then if you click this is brand new in the last couple of days, guys. If you haven't seen this already, you click right here where it says Meet the Coaches, and you get a chance to see a little up close and personal visit with each one of us. And you can learn a little bit more about us. Now, if you want to learn more about these topics that we've talked about, including the ones that Cameron's put out there in the chat, if you want to learn more about butterfly spreads, just come on over here to the Trader Talks webcast page, hit butterfly, and now you've got Brent Morris talking about the basics of butterfly spreads. You've got Brent talking about, you got me talking about butterfly spreads. You've got Cameron talking about butterfly spreads. Lots of different results there. And all we ask from you is that you just click on that subscribe button right there. And now also give us a follow over on social media at Ben Watson CS, at Cameron May CS on X. And then there's also the LinkedIn handles right there as well. My thanks to all of you. My thanks, of course, to Cameron May for helping out today. Thanks to you. Have a great weekend. If you are in any place that's being impacted by the weather, please be safe and stay warm and stay safe. Other than that, we will see you guys back here. I think we've got market and sector analysis coming up next, and then have a great weekend. And then we'll see you back here on Monday morning for more great stuff. Take care, everybody. Bye-bye.